Hello, everyone, and welcome to Fridays with Vistage webinar. My name is Sarah. I'll be your technical producer from GoToWebinar, and I just want to go over a few items to help you participate. If you are experiencing any technical difficulties, you can dial support at 888-259-8414. That's 888-259-8414. When you joined today's webinar, you selected to join either by phone call or computer audio. If for any reason you would like to change your selection, you can do that by accessing your audio pane in your GoToWebinar control panel. During the presentation, all participants will be in listen-only mode. This simply means that you are muted so we don't pick up any noise from your end. We do welcome and give you the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of your control panel. You may send in your questions at any time. We will collect these and address them during a Q&A at the end of today's presentation. If you have any technical difficulties and you don't want to dial the 800 number, you can also type them in that questions pod and I will respond to you directly. Please note that we have a PDF of today's presentation available for you to download in the handout section of your control panel. Just expand that handouts part and then you'll see a blue link you can click on to download that file. A recording of the presentation will be sent to attendees via email within the next week. Okay, I would now like to introduce your moderator for today's webinar, Bill Black. Welcome, Bill. You now have the floor.
Welcome to Fridays with Vistage. My name is Bill Black. I'm a Vistage member and speaker, and I'll be your moderator today. And the title of our webinar today is Essential Succession Planning for the Savvy Business Owner. Now, when you think about it, succession planning is essentially estate planning for businesses. It's an essential tool to use in protecting your business interest, as well as maximizing the value of your business for your loved ones, and ensure that all of your key employees will keep their job even when you're gone. Business succession planning allows for the assurance of an agreeable price for the departing partner's share. Furthermore, succession planning allows for the ability to buy the departing member's share quickly and with no interruption in business. So today we're going to learn how we dictate exactly what happens when an owner or member of the business exits, so there's no room for interpretation as to what happens to the business. And our speakers today are from the Presser Law Firm in Boca Raton, Florida. They are Scott Roberts. Scott is a certified public accountant and the business succession specialist for the firm with over 20 years of experience in the financial industry. Previously, Scott worked as an estate planning specialist for a well-known financial planning firm headquartered in Atlanta. And Ariel Ennisman. Ariel is an attorney at the Presser Law Firm, which really specializes in helping both individuals and businesses in connection with the establishment of comprehensive asset protection plans that incorporate both domestic and international components. Now, here's something you'll love about Ariel and Scott. They're both Vistage speakers. So if you like what you hear today, tell your chair, and they'll be happy to speak to your group. Ariel, take it away.
Thank you, Bill, and thank you, everyone, for joining us this afternoon. As Bill mentioned, my name is Ariel Ennisman. I'm an attorney with the Presser Law Firm, and we specialize in asset protection. So what is asset protection? Asset protection is the legal process of titling both your personal and business assets to put them beyond the reach of any future potential threats and creditors. So what we do as asset protection attorneys is we work with individuals, we work with businesses, and our goal is to protect any asset you have. So whether it's shares in a corporation, whether it's inventory, equipment, any asset in the business, if it's stocks, bonds, any personal assets, what we want to do is protect any asset that's worth any value from any financial threat. So that could be divorce, that could be foreclosure. Mostly this day and age, it's lawsuits. And a lot of times people will say to me, well, do I have enough assets to protect? And the short answer is absolutely. In fact, the less you have, the more you want to think about protecting it. And I'll give you an example. We had a school teacher come in. She saved up a few $100,000 over her lifetime and was nearing retirement. Well, if God forbid she gets into a car accident or something happens and she's sued for $1 million, that could be catastrophic. There could be no coming back from that. Contrast that with some of the professional athletes we work with or some of the major business owners. Certainly if they're sued for $1 million, they're not happy, but their business is not going to go out of business or their lifestyle may not change. So the less you have, really the more you want to protect it. And the other question I generally get is, well, what if I already have an asset protection plan in place? And I think that's great. And a lot of people have, some minor strategies put in place. But no different than you go to the doctor every year and you have a physical. Well, you need a financial physical every year. The laws change, the assets change, your threats, your creditors might change. And probably one of the biggest misconceptions we see in our practice is we get the call, all the time, don't worry, I've put everything in a trust and I'm totally protected. That's probably one of the biggest misconceptions we see, because most of the time, the trusts that people set up are great for estate planning, but they don't offer you any asset protection. So our goal here at the law firm is to integrate not only the asset protection with the estate planning, but also with the business succession planning. That way our clients have a full comprehensive plan. So their assets are protected while they're alive, and then they have something to pass on through their business, through their personal lives, and tie in the estate planning and the business succession planning. So it's very important that you have a comprehensive plan. You don't focus on just one aspect. And that's why we have Scott today, who is our business succession specialist, and he's going to take the floor from here and really spend the rest of this presentation on business succession strategies and how to pass on the business. So I'm going to go ahead and pass the phone over to Scott.
Good afternoon, everybody. I'd like to start off with a few business statistics. Some of these might not be shocking to you, but a lot of people look at these and they are a little surprised by them. The first one, that the average business owner retires at age 71. The next one, 83% of business owners want to see their business continue, but this is the one that a lot of people are not aware of. 80% of businesses will never sell. They'll simply wind down and close their doors. And that's an important point, because a lot of people will go throughout their professional career building their business, and they think that really their ultimate exit plan is going to be to sell that business. And while that certainly could happen, especially if you're proactive about it, a lot of times it doesn't. And so that there's some things to think about and what happens if you don't sell it. 33% of baby boomer companies successfully transition to the second generation. And this is where people kind of raise a few eyebrows. Only 13% of baby boomer companies successfully transition to a third generation. So what's happening along the way is that maybe they didn't get the people in place who could run the company correctly, or there were issues with taxes and so forth. So those are some of the things that we'll talk about today. Only about 13% of company owners have any kind of exit plan or timetable in place. And in a study, they found that 96% of boomers agree that, hey, an exit strategy is definitely needed, but 87% of them didn't have a written plan, and 75% didn't have a plan at all, meaning they really hadn't given it much thought. So when we think about business succession planning, if you think about it, businesses can fall into three really broad categories, and their needs and the way they go about their planning are quite different based on how they're owned, etc. The first area, and the rest of today, we're going to talk about each of these three areas. The first is where you have partners in the business. So 2 or more partners in a business, how do you deal with the succession planning if one of the partners was to pass away or become disabled or retire, leave the company, what have you. The second one is maybe there's no partners in the business in the sense that everybody is related. In other words, maybe it's a father or mother who started the company, and maybe kids are coming into the business, and how do you deal with those situations? And then the third one is probably the most difficult to deal with, and that's where there are no partners in the business, nor are there any family members. And so, in essence, you're in a situation where there's no heir apparent. How do you deal with that situation? And I'll tell you that if you go from 1 to 2 to 3 of these categories, you'll find that it's a lot more clear cut what you can do and what you should do in number 1. There's still pretty clear cut as to what you could do, but there's more options in number 2 there. And number 3 ends up being a little bit nebulous. And it's sort of, well, it kind of depends on what you want to do. How important is it to make sure that you preserve the company for the employees? Those types of questions need to be considered. So when you're talking about, so let's take that first category where you have partners in the business. A couple of questions I always ask people are, number 1, how would you feel about being having your business partner's spouse be a shareholder with you. And if that's usually the number one issue that I get when I'm talking with my clients, is the number one thing they want to avoid. Number two, how would you feel if your family didn't receive the fair value for all your hard work? Without a plan in place, if you were to pass away, somebody could come along and buy it for, pennies on the dollar, depending upon what kind of situation the company's in at that point in time. And then number three here, how would you feel about giving the government extra taxes? I know most people are sort of against that. I know I am. And so that's something that we always want to keep in mind as we're going through and doing the planning. So let's talk about, when you have partners in the business, what are the main things? And these are 5 things that I always talk to my clients about when they have partners in the business. The first one, it's kind of obvious, probably people have heard about it, but it's just so important to make sure that you have an actual written buy-sell agreement that's binding and arm's length. The main reasons for that is that it addresses some of those questions on the previous page. Number one, if you have a buy-sell agreement and there's a mandatory buyout provision, if your partner were to pass away, well, then the surviving spouse will not become a shareholder because you'll buy them out and they have to sell you the stock. So it deals with that very important issue that people are concerned about. The second is that it ensures that I'm going in opposite order here of these bullet points. The second is that it'll ensure the value for the business interest. So if you wanted your family to get, say, $5 million for your business, and if you didn't have a buy-sell agreement, they may or may not get that. But you can, quite frankly, just write it right into your buy-sell agreement, and you can have that amount will definitely go to them. You can fund it with insurance. We'll talk about that. You don't have to. There's different ways of doing that. And then this last bullet point, which is the first one on here, it sets the value for tax purposes. This is something that a lot of people don't think about. But if you were to pass away and you have a business in your estate, the IRS is going to come along at some point. Let's say that you're the second to pass away if you're married, and the IRS is going to come along and they're going to value your business for estate tax purposes. And they have 9 main ways that they value businesses. And let's face it, they're probably going to come up with a value that's high because they want to collect more in tax. Well, if you have an arm's length binding agreement that says this is what the value is, then by definition, you have established what the fair market value is, which is what they would base their tax on. So a properly written buy-sell agreement can peg the value of your business for estate tax purposes. And we've seen situations in the past where people do not have buy-sell agreements. They get into wrangling with the IRS. Those types of things can take not just years, but even a decade or more to resolve. And invariably, the value upon which everyone settles is going to be higher than what you would want from a tax perspective. So anyway, that's the first thing. You definitely want to have a buy-sell agreement for those reasons. Now, oftentimes I'll see that people will have a buy-sell agreement and maybe they're just using the standard language that came in the buy-sell provisions section of their operating agreement. And what I've found is that a lot of times those will have mandatory buyout provisions in situations where you don't really want them. So one of the big considerations here is number 2, what do you want to happen on each of the triggering events? So upon death, it's usually assumed, and most people would want, that you would want a mandatory buyout. So in other words, if I were to pass away, I would definitely want my partner to have to buy my stock because I want to ensure that there's a market for it and ensure that the liquidity goes to my family. However, what if I become disabled or what if my partner becomes disabled? Now I'm on the other side of it. If there's a mandatory buyout provision and my partner becomes disabled, well, now I have to buy him out or her out. And where do I get that money from? When somebody passes away, you can usually use life insurance to fund that buyout. When somebody becomes disabled, it's a lot harder to do that. Now, there are disability buy-sell policies, but my experience, and I literally looked at one just last week for a client, they end up being much more expensive than people are willing to pay. because you may or may not use them. So most people aren't willing to do that. So a lot of times what I will recommend is for a disability is to make that a discretionary buyout. In other words, you don't have to, and you sort of determine if you want to. You can negotiate that. So sort of a first right of refusal, if you will. And then the third area is if somebody retires or leaves the firm or the company, then I put that into the same category. If you can't have a ready source of funds to make that buyout happen, then you don't want to obligate yourself to do that. You might do it, but you might do it over time. You might not do it all at once, and you do it at a pace that would not financially harm the company. So those are kind of the reasons why we have a buy-sell agreement, and then what's some of the provisions inside the agreement that you want to consider. Now, buy-sell agreements, they're not all created equal. And a lot of people will say, well, I have a buy-sell agreement, so I'm all set. And, having one is certainly better than not having one, but one may be better than the other. So there's two main types of buy-sell agreements. One is a cross-purchase agreement, and the other is a redemption agreement. And the difference between the two is just simply what is the entity that's doing the actual buying. So in a redemption agreement, if I were to pass away, the company would be the entity that would buy my shares. In a cross-purchase agreement, if I were to pass away, my partner would individually buy my shares. Now, on the surface, it doesn't sound like there's much difference between them, but there is actually it could be a pretty significant tax reason to do one versus the other, and that's because with the cross-purchase, and I'm going to illustrate this on the slide, with the cross-purchase, you'll get a full step-up in basis, so if you later sell the company, you'll pay less in taxes. And I actually have a slide that kind of illustrates that for you, so just kind of keep that in mind. I also have a slide that deals with these next 2 points. Funding the buyout, does it make sense to, or how are you going to fund it? There's really 4 different ways. You could fund the buyout with just the cash flow of the company. You could sell off some assets of the company. You could borrow. And then, as I mentioned before, you could use life insurance. And I've got a slide that sort of explains that. And then this last thing, how do you structure the funding? And there's something called indirect funding that I'll explain when I get to that as well. So the first thing I want to do then is to sort of illustrate graphically the difference between a stock redemption and a cross purchase. And really, it all comes down here. If you look at the middle box of each side of this, that's the entity that's actually doing the buyout. And in one side, it's the company doing the buyout. And in the other side, it's the shareholder that's doing the buyout. And the main reason, they're all kind of the same. All the bullet points are the same, except if you go down, you'll see that on the company side, there would be no or a minimal step up in tax basis when that purchase happens, whereas on cross purchase, there would be a full step up in tax basis. So let me illustrate what that means from a numbers perspective. So let's say that we have a $20 million company, and I have a partner, and so we each own 50% of it, which would be $10 million each. And let's say we have each put $1 million into this company to get it up and running. So our basis in the company is $1 million. So now let's say my partner passes away. And so I'm going to look at these 2 different columns. Look at the redemption column first, if you would, please. And there you see the buyout of the partner is $10 million, and it's the company that's paying that to my partner, or the company that's paying that out. So let's say that some years later, or even immediately after, I sell the company for $20 million. Well, my basis is still only $1 million. So my gain is $19 million, and I'm rounding the tax rates here and just calling it a 20% capital gains tax rate to make it easy. So $3.8 million in taxes, so I net $16.2 million. Now let's say, exact same situation, except that I have a cross-purchase agreement instead. So now, when I buy out my partner's estate, I'm the one who pays the $10 million. So now my basis is 11 million, the one from before plus this 10 million. So when I go to sell the company for 20 million, my gain is only 9 million. My tax is 1.8, so I'll net 18.2. The bottom line is just by having a different type of agreement, I can save up to $2 million in income taxes and capital gains taxes. Now, is it that pronounced in every situation? No. But even if the difference saved a couple $100,000 in taxes, it probably makes sense to explore if it makes sense, to have a cross-purchase agreement. One thing I'll mention that oftentimes when you have multiple business owners, it gets a little bit more difficult to do a cross-purchase agreement. For 2 owners and 3 owners, definitely doable. I've done for 2 and 3. For 4 and more, sometimes people revert back to the redemption just because it's simpler from a structure standpoint, but something to keep in mind there. Now, if you recall, sorry, I'll go back here. In each of these situations, we're assuming that there's just $10 million that's available to do the buyout. In one case, it's the company has $10 million, and in the cross-purchase, I had the $10 million to buy my partner out. Well, where does that money come from? And again, as we mentioned before, you recall, you can fund it out of the operations of the business or sell off assets, etc. But what generally happens is that if people don't plan and if they don't have life insurance, we usually end up in a situation like this where we'll have to buy out somebody over a period of years. And so let me illustrate this. Let's say that, again, I'm going to buy out my partner, $10 million over 10 years, and let's assume we're looking at a 4% interest rate and an income tax rate of just 35% to make things rounded and simple. So each year, I'm going to pay $1 million in principal. I have to pay some interest each year, so my total payment is going to range between $1 million and $1.36 million. Now, this is an after-tax payment, so we're going to have to pay taxes on that. So what's the profit that's required in order to net that amount to pay? You'll see that's the final column there. And if you add all that up, we have to earn $17 million over 10 years just to buy out a partner who has passed away. And what a lot of my clients will tell me, that ends up being a significant burden on the company. And if you take it one step further, let's assume that the company has a 25% net profit margin before taxes. Well, in that case, in order to earn that $17 million, you need to have over $68 million in sales just to buy out the partner. And so $68 million in sales over 10 years is dedicated not to growing the business or to providing profits, but just to buy out the partner. So what's the solution to that? You get a cheap term policy. So, and when I talk about buy-sell agreements, I'm almost always talking about a term policy as opposed to a more costly permanent policy. There's lots of good uses for permanent policies, but overwhelmingly, and there are exceptions, but overwhelmingly, term insurance is what makes sense for buy-sell agreements. The main reason being it keeps the cost low. You don't know how long you're going to need it. You might sell the company. The ownership might change, those types of things. So just something to keep in mind on that. That's why people use life insurance to fund agreements. Now, this next slide here is the indirect funding concept to which I referred before. This is a scenario where, I've been doing this since 1993. There's only been 2 cases where I came into a situation where they had done something similar to this before I talked to them about it. And I don't want to take credit for it. I learned it from somebody else. But it's basically the typical way that people will do it is on the left side here. You have the buy-sell agreement. And again, keeping the numbers consistent, we have this $10 million buyout. So people will look at it and they'll say, you know what, we need a buy-sell agreement. Let's do a cross-purchase agreement. That makes sense. Let's fund it with life insurance. Now we have a $10 million policy. And so they'll do it this way, and the buy-sell agreement will peg the value at $10 million. Certainly a pretty good scenario, but here's what happens. Depending upon where they are relative to the estate tax exemption, let's assume that they are in an estate taxable situation. That whole $10 million then is subject to estate taxes. So $4 million in taxes and $6 million ultimately goes down to the heirs. Now, a different way of doing that is to split the coverage. Take the $10 million and split it into two different policies. Now, in this example, I'm assuming that $6 million then is the value of one share of the business. In other words, one half of the business. So we're assuming a $12 million company. So a lot of times people say, well, I thought it was worth 20. How are you saying that it's only worth 12? And of course, the answer to that is, well, how much is that building down the street worth? I could get somebody to say it's worth 3 million, and I can get somebody else to say that it's worth 5 million. So it certainly needs to be a number that you can justify. A lot of times you can simply take book value of the company, maybe take an average of a couple of those 9 different methods I referred to before of how people value companies. So $12 million, if we can justify it, then it makes sense and we can do this. So we then peg one half of the company at $6 million, and that runs through the buy-sell agreement. It's taxed, $2.4 million in tax, and $3.6 million down to the heirs. And then we take the other $4 million that we really wanted for the company, and we put that out into an irrevocable life insurance trust. And so it is outside of the taxable estate, no taxes on those proceeds. So that $4 million escapes that taxation. So a total of 7.6 to the heirs. So $1.6 million more to the family. Another way of saying that is less to the government. And all we did was change how we structured the funding of the buy-sell agreement. So the next area that we'll talk about is when you have business succession planning issues, you don't have partners, but there are family members in the business. And this is the sort of traditional way that a lot of people will think about it. If they have children that are coming up and entering the business, how do I transition the business to them? And in doing that, as was referred to earlier in the introduction, it in essence becomes a question of doing estate planning. So it's estate planning for the business because you're really just trying to reduce the taxes as much as you can. You could potentially, as number 1 says here, have a buy-sell agreement. There are agreements, between parents and children, or maybe there's a niece or a nephew and you have a buy-sell agreement, you fund it with life insurance. But more often than not, it's a case where the assets are being left to the next generation, the business is being left to the next generation through the will. And so we're just trying to reduce the estate taxes. So when I talk about estate planning, whether somebody owns a business or not, you're really talking about doing 4 things. And within these 4 things, it can get a little complicated, but at a sort of a very basic level, estate planning boils down to just doing 4 things. Number 1 you'll see here is that we want to effectively utilize all our exemptions that are available to us under the law. And I'm talking about exemptions related to gift and transfer taxes. So there's 3 main ones that we deal with. The first is the annual exclusion, which this year is now $15,000. So you can give to as many people as you want, $15,000 per year, and there's no tax. And let me take one step back. Some people aren't even aware that there is a transfer tax. They're familiar with an estate tax, but a lot of people are thinking, wait a minute, if I want to give something to my kids, I can't do that. Well, you can as long as it's below $15,000, which obviously the majority of gifts are. But anytime an asset, anything of value, transfers from one owning entity to another, there's a transfer tax unless you qualify for one of these exemptions. So the $15,000, that's something that we talk to our clients about using. You do gifting of company stock over a period of time, you can actually transfer a decent amount of a company to the next generation. There's also the lifetime exclusion, and I'll pause here just a little bit and talk about the new tax law because that's fresh on a lot of people's mind. Had they not passed that new tax law, the lifetime exclusion right now was going to be $5.6 million per person. So That means that a married couple could pass 11.2 million to anyone they want, generally the next generation, with no taxes. So if everything you owned is below that, including your business, you really didn't have an issue with taxes. Well, the new tax law has doubled that, and so now it's 11.2 million per person. So a married couple, that's $22.4 million that they can pass to the next generation with no taxes, which is a great thing. The problem is, and many of you may be aware of this, is that the way the tax law was written, and I will spare you the details as to why it was written that way, has to do with Senate rules and so forth. But that $11.2 million only goes through 2025. So in 2026, the exemption falls back down to where it is right now, plus inflation. So at the end of the day, unless you're planning on dying in the next 8 years, the exemption doesn't do a whole lot of good unless you're also planning on gifting a whole bunch. So you can take your 22.4 million and gift it all away now, and then you can ensure that you took advantage of that higher exemption. But a lot of my clients are not in the situation where they want to be doing that. So all that to say, right now in 2018, the lifetime exclusion is 11.2 million, but when we're looking at projections, we're usually looking, 20, 30, 40 years down the line. You have to at least base your planning on what the current law says, and then you adjust it as time goes on. So that's why what I've been doing for my clients lately is running both projections and having a conversation about it. One projection assumes that the exemption is the 5.6 plus inflation. The other one assumes it's the 11.2, and we just kind of look at things. So the other thing that you want to, and the way that you take advantage of those exemptions is just making sure that in your wills or your revocable trust, you have language in there that's making sure that you're availing yourself of those deductions. It's usually pretty simple. You probably recall from your wills, you'll create a credit shelter trust, also called an exemption trust, and then the balance of it will go into a marital trust if you're married. Those types of provisions in documents will make sure that you're utilizing your exemptions. You could also do some gifting during your lifetime, and there's some reasons to do that because you can get future value outside of your taxable estate. So something to keep in mind there. This last thing where it says GST, that's a tax and an exemption that some people aren't quite as familiar with, and so I'll just explain it to you this way. Years and years ago, very wealthy people would look down at their children and say, well, gosh, my children already have a lot of assets in their name. Why don't I just give things directly to the grandchildren and I'll skip a generation of taxes? We don't like the IRS that much sometimes, and we kind of make fun of them, but they're actually pretty smart. And so they said, no, wait. You're not going to get away with that. If you did do that, if you make a transfer to grandchildren, we're going to tax you once for the transfer, and then we're going to tax you a penalty tax on top of that just happens to be equal to the estate tax rate, so you basically didn't get away with anything. Now, the IRS also likes to complicate things, so what they did say, though, is they said, but we will let you do that with a certain amount. And that amount, unfortunately, is confusing because it's the exact same number as the lifetime exclusion. So it's the 5.6 or the 11.2, whatever time you're looking at. But they're two different exemptions. So the first, let's talk in terms of the 5.6. The first 5.6 exemption gets it from parents to children. And then that same 5.6 million then gets allocated another exemption, this GST exemption, which gets it from children to grandchildren. Now, it kind of sounds a little confusing, but again, all the language that does that is in your revocable trust or your will. And the way you know you have it is that if you have a will or revocable trust, that when the assets go down to the children, it stays in trust for the children's entire lifetime and then goes to grandchildren. So that's the way you can kind of know that. So that's the first thing we do is try to avoid as much tax as we can by using all those exemptions. The second thing we try to do, and this is where estate planning starts to really integrate with asset protection planning, is that we try to discount assets for tax purposes. We try to take something that, for example, is worth $10 million and make it look like it's worth only $7 million as an example. And the way we do that, we can use a limited partnership, which we use a lot in asset protection planning. And we can also use, if it's an S Corp, we can do a recapitalization of the stock into voting and non-voting shares, with the non-voting shares not being as valuable there by having a discount to their value. Just quickly, the way a limited partnership works, if I had a $10 million building and somebody came along and wanted to buy half of it, I would say, okay, give me $5 million. And they would say, okay, here you go. Now let's take that same $10 million building, and I own it inside a limited partnership. And somebody comes along, wants to buy half the building, and I say, sorry, it's inside the partnership, but I'll sell you 50% of the limited partnership interest. So just go ahead and give me $5 million. And they're going to say, you're crazy. It's not worth $5 million because you're the general partner. You completely control it. So there's a lack of control discount. And who's going to want to buy my 50% of a limited partnership interest? So there's a marketability discount as well. The combination of those discounts, we can make assets in general about 30% less. It depends upon the assets that are in the partnership. Very liquid assets, you're looking at 15 to 20%. And things like real estate, that type of thing, you can even get as high as 40. The IRS has fought these types of discounts repeatedly, and they repeatedly lose unless the taxpayer does something silly, which is probably beyond the scope of this conversation, doing something, a deathbed transfer to a partnership and trying to take a discount, that type of thing. So that's the second thing we do, is we try to discount. The third thing that we try to do is try to shift assets and shift the growth. And before we were talking about annual gifting, and then if you wanted to use some of your lifetime exemption during your life. Well, the benefit of doing that, if I take $1 million and I give it into a trust for my children, and that $1 million grows to $3 million, well, then I've saved the estate taxes on $2 million. So I've saved essentially $800,000 in taxes. So gifting is one way to do that. There's also ways where you can do a sale to a trust if you've used up all your gifting. There are ways you can use GRATs, Grantor Retained Annuity Trust. That's a term that many of you may have heard. But all these are techniques to shift growth out of in our example, the parent's estate into the children's estate or beyond, into trust, etc. Once we've gone through and we've done each of these 1, 2, and 3, we've essentially sort of pounded down the tax as much as we can. And then the question becomes, well, what do you do if you still have a tax? And I'll tell you, there's really only 4 ways that an estate tax gets dealt with. And if you've heard of any other ways, they're really just a derivative of one of these. Those 4 ways, and I'll explain a little bit on a slide in a second here, but you could have cash. So if you had $1 million in taxes, you could have $1 million of cash lying around. You could liquidate, you could sell off assets, you could borrow, and then some people use life insurance as well. And so I've got a slide that kind of addresses that as well. And then this third bullet point that I wanted to make sure I talked about here is that when you're talking about family members and coming into the business, one of the biggest things that I've seen people do wrong is they wait too long. They bring somebody, maybe it's a son or a daughter, they bring them into the business. They give them some work, but they don't really incorporate them into the overall planning and what's going on. And I'll mention this later when I talk about when you don't have partners or family members in the business and you're talking about a key employee. Sometimes a lot of the information is imparted to the next generation. So this is how you do the business. This is how you run it, et cetera, et cetera. But they wait too long to introduce them to all their relationships, the social capital that they've developed over decades of building a business, whether it's with their vendors, their customers, those types of things. Those are things where, come up with a plan and think through when and how you're going to do that, because that's one of the biggest things that I've seen people do wrong. They wait too long to do that. So this slide right here is showing once you've done the estate planning, we've reduced the tax as much as we can. Well, then, what do you do about the tax? And this kind of gives you a comparison of the four things that I talked about before. So the purple bar there, that's cash. So for every $1 million of tax, you could have $1 million of cash lying around. The green bar, that's if you sell off assets, and we assumed a liquidation factor because the taxes are due 9 months from the date of death. And especially if you have any kind of illiquid assets, they may be difficult to sell so quickly. Even if you are liquid, maybe the market is down and you need to sell off assets. And then quite frankly, people end up finding out that you need to raise the money and you're trying to sell something and they know you need the money quickly. And there have been examples of that. So that's if you liquidate there. And then the blue bar is if you were to borrow. Obviously, it's dollar for dollar plus interest. There is a section in the tax code called 6166. It's where a business, if they qualify, can, in essence, borrow from the government. You're still borrowing. It's just at an attractive interest rate. And there's other things in the tax code that can help out. There's a Section 303 redemption, but that's really just a cash transaction, just allows you to get money out of a business to pay estate taxes. So again, these are really the main ways to do it. Anything else is just a derivative. And then this orange bar over here, this is the reason why a lot of wealthy, smart people use a properly structured and the proper type of life insurance policy to deal with estate taxes, because they'll never pay as much into it as they get out in death benefit, which means by definition, they are discounting their taxes. And in this situation, and I ran two different situations to give you an idea. These are actual clients of mine, 82-year-old male and 74-year-old female, because some people are always thinking, well, I'm too old, number one, to get life insurance, and if I did, it would be too expensive. And yes, as you get older, health-wise, it's harder to qualify for insurance, but you can still do it, and the benefits are still there. So in this case, they're reducing their estate tax erosion by 62%. And one thing I'll point out is that smart people will look at this and they'll say, okay, the three bars on the left, those are all events that I don't have to deal with until the future. Whereas if I did like life insurance, I would have to start paying premiums now. So there's a time value of money component. And so that's why I run this rate of return analysis. And for the couple that I was just mentioning, per $1 million, it would be $27,000 per year of premium. Well, the question then is, if they were to take that $27,000 and they invested it somewhere else, what would they have to earn on a gross basis in order to get the $1 million of death benefit? And of course, that depends upon the age. But if you run out to life expectancy, in their case, it's 13.5% that they would have to get. And of course, you can get guaranteed policies. So, a question always comes up, can you beat 13.5% or 13.9% guaranteed? So anyway, and then just quickly, this is with a younger couple, just to show what that looks like. It's the same concept here with the lower bar for the orange. Obviously, their premiums are a lot lower. Per million, it was only $4,000 a year. Because they were paying for longer, even though it's a lower amount, their internal rate of return was actually a little lower. But it's still close to 9% at life expectancy. So again, that's the reason why people use life insurance to deal with estate taxes. So I was mentioning before about selling off assets. How would you feel if your company had to be liquidated to pay estate taxes? That's one of the big fears that a lot of my clients have. I don't know who on the call might be familiar with the Joe Robbie situation, but years ago, he was the owner of the Miami Dolphins, and he owned the stadium down here, and he passed away. Ironically, he was an attorney, but had not done enough estate planning, and there was about a $35 million estate tax that was due, and unfortunately, they didn't have the cash and needed to raise it quickly, and so they ended up selling the team and the stadium for pennies on the dollar. And that's how Wayne Huizenga made a lot of his money, in addition to Blockbuster. So anyway, just a story, a real life example of somebody that some people are familiar with. So this one right here, I'll just talk for just a second. This is an actual case study of a client of mine. It's actually the whole family. Well, most of the family are clients of mine down here in Florida. I've been working with them for 17, 18 years. It's a family business worth about $200 million. G2, that's Generation 2, so not the ones who started the business, but they came into the business. So G2 is now running the business. They're in their late 50s and early 60s now. And G3 is beginning to enter the business. Interestingly, and we'll talk about this a little bit when we talk about key employees and what they can do, that the current president of the company is actually not of the bloodline. He married into the family, extremely sharp guy, and people recognize that, and now he's actually the president sort of running things. So I thought that was interesting. Two of the G2 owners had died, and last September, the last of the G1 owners passed away. She was sort of the matriarch of the family, passed away, and so a lot of the planning that we did was really coming to fruition, and I'll kind of explain what happened there. There's 10 remaining G2 owners, and the key to all this transfer of stock, think about it. Now you have branches on a tree where all these people are owning stock. The key to that is that each nuclear family is being really proactive about their own estate plan with gifting. They have a plan for liquidity. They've done some of these techniques that we've talked about, whether it's a sale to a defective grantor trust or a GRAT or those types of things. They're doing that kind of planning to ensure that it keeps passing down. And when the matriarch of the family just passed away, the IRS is coming back around already, and this is where this whole stock valuation comes about, if you can peg the value. When the husband passed away, when her husband passed away, even though there was no tax due because of the unlimited marital deduction, they were still trying to value things, and there was a real fight as to how they were going to value it. Obviously, the family wanted to value it low. The IRS wanted to value it high. And so they kind of said, we'll come back around when she passes away. And so we're all kind of expecting that there's going to be a little bit of fight over that. Fortunately, especially in the later years, she passed away at age 93. We did a lot of maximum gifting to both children and grandchildren. And because of the gifting and other planning, they had about $15 million of insurance. And I actually probably need to update that because they had sort of a spike in the value of their company, even the way they were valuing it, not just what the IRS was saying. And actually, they're going to be somewhere around $5 million short in actual cash, and they'll have to raise that probably through their line of credit with the business to pay that off. But at least the majority of it, 3/4 of the tax, was covered when she passed away. And then years ago, we did quite a bit of planning. They had some split dollar plans, which I won't go into detail on that. They had the second to die life insurance that they had. We had restructured those into trusts that incorporated generation skipping tax language. We did quite a bit of planning for them. And so this $4 million in tax savings that we did, that's actually probably on the low side. They're probably going to end up saving, even more than that. So the bottom line is this, that they were able to pass on now to the third generation they're working this company, and they've done it by being proactive, and along the way they're saving millions of dollars in tax savings. And also importantly, the asset protection is improving each time because they're using trusts and partnerships and so forth. So just wanted to share that case study with you to kind of give you an idea of sort of what it looks like. So now we're on to our last area of business succession planning. This is when there's no partners in the business and there's no family members that you're going to pass it on to as well. And as I mentioned at the beginning, this is a situation where it's by far the most difficult to say, this is what you do in every situation, because it just kind of depends. So let's talk through some of these different things. And some of these things I won't spend too much time because they can get really technical really fast. But the biggest and most important thing is number one here. Is there a key person? Is there a key person that if something were to happen to you, they could step in and run the company? And if there isn't a key person, then you have to find one. It's really that simple. And once you do find that person or people, then the key is, does it make sense to have some kind of a buyout? In other words, you pass away and maybe they have a buy-sell agreement with you, and maybe you fund it with life insurance. Of course, you're kind of paying the premiums for a policy to give the company to somebody else, but maybe you fund it with life insurance. And maybe you fund it with life insurance. Of course, you're kind of paying the premiums for a policy to give the company to somebody else, but maybe you fund it with life insurance. Of course, you're kind of paying the premiums for a policy to give the company to somebody else, but sometimes that is the right thing to do. And that's why this is sort of a nebulous area. There may be a situation where, maybe you have children, they're just not interested in running the company, but they'd like to own the company and benefit from it. So then maybe it's just identifying a key person who can run the company for the benefit of the family, and they can take distributions. So it just kind of depends. And there might be a way to customize too. And I put this example here. Maybe there's a third party buyer who's interested in the company, but they don't want to run it or don't know how to run it. And so maybe then that key person could run it for the third party buyer and kind of facilitate that transaction. Number 2 here, employee stock ownership plans, ESOPs. Won't spend a whole lot of time on this, but it's a way that your employees can essentially buy the company from you. It is a tax qualified plan. So there's ERISA regulations and things like that you need to follow. But there are some significant tax advantages of doing it. While you're doing it and you're still alive, you can retain some control. It can be funded via borrowing. In other words, you want to take some money off the table now. The company essentially can borrow from a bank and buy out some of your shares, and then those shares can be distributed to your employees. And the way that that's done, repayments of that loan are tax deductible. So there's some real tax advantage of doing that. And in a properly structured ESOP, it's actually very attractive to some of the employees because they want to stick around because they own some shares. And as you know, ownership, promotes people to be more responsible and work harder and so forth. So there's definitely some benefits there. Again, number 3, I know I'm repeating a little bit, but it bears repeating, which is in any scenario, developing a key person or people is critical. And as I mentioned before, when you're passing on a business to family members, you need to transfer that operational knowledge, but you also need to transfer client relationships and all your social capital that you have. Again, you need to do that at the right time. And maybe you have some agreements in place, some non-competes, et cetera, because there can be some ugly situations where, people become disenchanted and maybe feel like, well, I can do this on my own, that sort of thing. So, keep that in mind. And one of the things that is interesting is that a lot of people are always looking within their organization and trying to find that key person who can run things. And maybe that person isn't part of the company. Maybe you need to look outside the company to find somebody to come in to become that key person. And there are actually firms that specialize in doing talent searches just for that purpose. Not just hiring any old employee, but just to hire somebody who can come in and with an eye towards eventually sort of taking over and running things. And those firms can actually help with the implementation and then sort of bring them up to speed as well. Again, there's no partners, no families in the business, family members in the business. If there is any kind of buyout, where does that money come from? Was dealing on several phone calls with a woman who owns a business. She has the key employee, trying to figure out, though, how does the key employee buy her out? They've agreed that they want to do it. It's the perfect employee to do it. He's been with her 6 years. He knows what he's doing. She wants to do it. But the whole thing is, where does that money come from? Does it come from the operations of the business? And then the key employee takes that money and buys out the business owner. Of course, if you do that, then you're kind of buying yourself out. So you got to think about that a little bit. They could take a loan, but what can the key employee qualify for the loan? So quite a few things to think through in that regard. The other thing too is that when you find that key employee, you want to make sure that they stick around. So with the promise of the buyout, if you're not giving them some stock right away, there's some things that you might want to do instead. You could do stock grants and bonuses, kind of give them some. That's ultimately what the woman I was just referring to was going to do. You could create some phantom stock plans. Be careful. When this woman came and started talking to us, she had gotten some advice that wasn't quite right, and she was creating an income tax problem for herself. So, but you could do phantom stock where you don't actually give away the stock, but you can kind of give bonuses based on if they did. There's some sections of the code that allow you to do bonus plans to people, and you can gross it up so that net they don't have to come out of pocket for income taxes. And then one of the big things that people do to keep key employees is that they do non-qualified deferred compensation plans. So, people have heard of 401ks, those types of things. Those are qualified plans. A non-qualified plan is a way that you can, for that employee, they can set aside money in a tax-favored way for their retirement, and that ends up being quite the handcuff to keep them around and keep them happy to ultimately be that party who can run the business. So that's really the presentation today. So thank you all for listening.
Terrific job, Scott. We have one question if we could dive into. We only have time for about one question, and the question is an interesting one. Came from one of our listeners, and he asked, "What are some of the scenarios of a buy-sell if you establish a buy-sell and you establish a value on the date of the death, but the company is actually worth less? Let's say 60% of the established value."
Yeah, I'm glad. I get that question. I probably just need to put a bullet point in here that addresses that because I seem to get that every time. So thanks for asking that. And really, that question comes around to, how do you value the company and how do you ensure that the value is current at the time of death? And so I think the way that you make that happen is inside the buy-sell agreement. What I'm in favor of is having a stipulated value. So we say that our company is worth, in my example there, it was worth $20 million. So we stipulate that it's worth that amount. But then in the buy-sell agreement, it's going to say, but we agree that we're going to revisit this value every year or every 6 months, 2 years, whatever is appropriate for your situation. But what happens is life happens and people don't actually do that. So I always like to put in the buy-sell agreement a fallback valuation method, and in there there'll be a provision that says, yeah, we say it's worth 20 million, but if we have not recertified this amount in the last 12 months, 18 months, 24 months, whatever the number is that's right for you, then instead of that stipulated amount, we default to some type of formula valuation. And again, that's going to depend upon the industry that you're in, but maybe the formula valuation is 5 times EBITDA or 10 times EBITDA or 1 time sales or something like that. So I think
Excellent.
That's kind of the way that we do that. Mm-hmm.
Well, Scott Roberts, thank you so much for joining us today and enlightening us on this particular topic. Unfortunately, we're out of time for today. I want to thank you and Ariel Ennisman for joining us from the Presser Law Firm. And remember, Scott and Ariel are available as Vistage speakers, so tell your chair if you're interested, and they'll come talk to you. Thank you, Scott.
Thank you very much.
I'd be remiss if I didn't remind you that there are upcoming webinars with Fridays with Vistage, Friday, March 2nd, 10 a.m. Pacific, 1 p.m. Eastern, 6 key hiring trends for 2018 with Kathleen Quinn-Vota, one of our most popular speakers. On Friday, March 9th, 10 a.m. Pacific, 1 p.m. Eastern, engage and retain your most valuable employees in 2018 with Santiago Jaramillo. And I want to thank you for joining us today on behalf of Fridays with Vistage and Vistage Worldwide. I'm Bill Black, wishing you continued success. This concludes today's webinar.